The hottest commodity in 2026 isn't oil. It isn't lithium. It's a metal humans have mined for 10,000 years. It takes 15 years to open a new copper mine. AI needs the copper now. EVs need it now. The grid needs it now. The math doesn't work. In this episode, we'll answer 3 questions. First, why are 3 completely different industries all desperate for the same metal? Second, why can't the mining industry simply dig more? And third, which companies are best positioned in this squeeze, and who actually has the clearest runway ahead? Let's start with why copper matters. Copper is the second best conductor on Earth. Only silver beats it, but silver costs 100 times more. That's why every wire, every power line, every circuit board is copper. There is no plan B at scale. Now look at how much modern technology actually needs. An electric vehicle uses 180 pounds. A gasoline car, 50. That's a 3.6 times multiplier. A solar farm needs 4,400 pounds per megawatt. A wind turbine, 3,300. A data center server rack, around 400. These numbers matter because all 3 of these sectors are scaling simultaneously. And they all need the same metal. Revolution number 1: AI data centers. Each hyperscale data center campus requires approximately 30,000 tons of copper. 30,000 tons for one facility. And Big Tech has committed over $700 billion in AI capital spending through 2028. By 2030, S&P Global estimates that data center copper demand alone will hit 1.1 million tons per year. That's roughly 3% of total global copper demand, coming from a sector that barely registered 5 years ago. Where does it all go? About 35% goes into power distribution, busbars, cables, the infrastructure that moves electricity through the building. 28% into cooling systems. 22% into the servers themselves, the PCBs, the connectors. And 15% into the grid connection and transformers that feed the facility. Microsoft, Google, Amazon, and Meta have collectively committed to building over 50 hyperscale campuses by 2027. Each one requires as much copper as a small city. And that's before we count the grid upgrades needed to power them. Revolution number 2: electric vehicles. The numbers here are straightforward but powerful. A battery electric vehicle uses 180 pounds of copper. A plug-in hybrid, 85. A traditional gasoline car, 50. That 3.6 times gap means every single EV sold creates incremental copper demand that didn't exist before. In 2025, global EV sales hit 22 million units. That alone consumed roughly 1.8 million tons of copper. By 2030, most forecasts project 40 million units per year, pushing EV copper demand past 3 million tons annually. That's nearly double today's levels. And that's just the vehicles, not counting the charging infrastructure, the battery plants, or the factory retooling. And here's what most people miss: it's not just about the cars. Every fast charging station along the highway needs heavy gauge copper cable. The charging network is a copper network. Revolution number 3, and in my view, this is the most underappreciated of the 3. The average US transmission line is 40 years old. Substations, 42 years. This grid was built in the 1960s, and now it has to carry the load of 2030. Solar farms generating power in the desert. Wind turbines offshore. EV chargers in every suburb. AI data centers drawing hundreds of megawatts each. That's not an upgrade. That's a complete rebuild. Copper demand for grid infrastructure alone is projected to reach 1.1 million tons per year by 2030. Renewables require 4 to 5 times more transmission copper per megawatt than fossil fuels, because the power is generated far from where people live. The US faces a $1 trillion grid replacement backlog. Europe has a similar problem. And the emerging markets, India, Southeast Asia, Africa, are building grids from scratch that will be copper intensive from day one. 3 massive demand waves, 1 supply constraint. Why can't miners just dig more? Opening a new copper mine takes 10 to 17 years. Exploration, feasibility, permitting, construction, ramp up. No amount of money compresses that. New copper discoveries have fallen 70% since the 1990s. Average ore grades have halved. The easy ore is gone. Chile has 13 new projects worth $14.8 billion in the pipeline, but none produced before 2028 or 2029. S&P Global's conclusion: only 70% of 2035 copper demand can be met with currently known projects. That 30% gap isn't a price problem. It's a time problem. The mining world's biggest players see exactly this structural shift and they're acting on it. BHP, the world's largest miner, hit a milestone in fiscal 2025 that would have been unthinkable a decade ago. For the first time in the company's history, copper generated more than half of its operating earnings, 51%, overtaking iron ore. BHP produced a record of just over 2 million tons of copper, up 8% year over year. Rio Tinto tells a similar story. Copper production rose 11% to 883,000 tons, and copper segment EBITDA surged 114% to $7.4 billion. Copper now represents 30% of Rio's total group earnings, up from about 15% just 2 years ago. In my view, this is the most telling signal in the entire copper market. When the two largest diversified miners on Earth are both reallocating capital away from iron ore and toward copper, they're not making a trade. They're making a generational bet. 8 companies. 3 tiers. Freeport-McMoRan, the world's largest listed copper producer. 28 to 31 billion in revenue. Hit hard by a 2025 Grabberg mud rush, targeting 85% restart by late 2026. Southern Copper, the sector's margin king. 46% operating margin on 13.4 billion in revenue. Ivanhoe's Kamoa-Kakula, the highest grade large copper find of the century. 300,000 tons this year, 400,000 next. BHP and Rio together produce nearly 3 million tons. Copper now drives over half of BHP's earnings. Mid-cap tier, Teck sold its coal business to go all in on copper. First Quantum brings scale from Africa. London Mining is the quiet compounder. Pause the video if you want to study the full table. Now let's look at the projects that are supposed to close this gap and why they can't. The biggest single capex commitment is Freeport's El Abra expansion in Chile, $7.5 billion for 300,000 tons per year. But it's still in early stages. Kamoa-Kakula Phase 4 is further along. Ivanhoe expects total output to rise from about 300,000 tons in 2026 to over 400,000 by 2027. Oyu Tolgoi, Rio's Mongolian megaproject, is already ramping its underground mine toward peak production. Teck's QB2 in Chile is the nearest to full output, already producing and expected to hit 300,000 tons per year in 2026. But add up every major project in the pipeline: El Abra, Kamoa, Oyu Tolgoi, Tia Maria, QB2, even Cobalt's Mingamba, and you get roughly 1.4 million tons of new annual supply at peak. The projected gap by 2030 is 3 to 5 million tons. Even the biggest projects in the world, all succeeding on schedule, won't close it. Every thesis has risks. Let me be direct about 4 of them. The biggest is China. China consumes roughly 55% of global copper. A sharp slowdown in industrial output or a deeper property collapse could temporarily swing the market from deficit to surplus. But even in this scenario, China's own grid modernization and EV push provide a floor. Second, U.S. copper tariffs. The proposed 25% tariff aims to reshore production, but American mines can't expand fast enough to replace imports. Short-term disruption, long-term investment incentive. Third, operational risk. Grabberg proved this in 2025. One mud rush at one mine took meaningful supply offline. The DRC, Peru, and Chile all carry political and environmental risk. Fourth, aluminum substitution. Automakers and cable manufacturers are experimenting. But here's the reality: aluminum's conductivity is only 60% of copper's. You need a thicker cable, which means more weight, which means more cost in other ways. Substitution is possible at the margins, but it can't replace copper at the core. Here's how I see the next 12 to 24 months. Most likely path: copper stays above $10,000 through 2027. 60% probability of reaching 13,000 if Grabberg stalls and AI capex accelerates. Watch these 3 signals. First, Grabberg restart. Freeport targets 85% by Q3 2026. Second, Chile permitting pace, 13 projects, $14.8 billion waiting. Third, London Metal Exchange warehouse inventory, below 200,000 tons means structural tightness confirmed. Catalysts: a U.S. copper tariff triggers reshoring investment. China slowdown creates temporary surplus. Upstream, watch Caterpillar and Komatsu. Downstream, wire and cable, and EV charging infrastructure. I'm Big Z, follow me, see you in the next deep dive.